Welcome back to our channel. Today we are going to discuss an important topic that has been, the discussion point for businesses across the last month or so. And rightfully so, because the complications that arise out of this provision are far reaching and have a wide impact on various businesses. And what we have done as a part of our knowledge sharing initiation is that today's video will encompass all the provisions in a detailed manner, yet in a crisp and easy to understand fashion, and would be your single source for referring to this provision and would serve as a single guide for taking all decisions that are necessary for complying with this provision as well as planning around the nuances of this. So let's dive into what we'll be discussing today. The first thing we'll be discussing is about the applicability of this provision so that we understand when does it come into picture and for whom does it have an impact. We'll understand briefly the MSME law because that's important to just get a feel of it. We'll discuss what exactly is the newly inserted clause H in 43B. We'll discuss some case studies. We'll go through some difficult situations, certain problematic situations where there is a significant impact and a lot of judgmental call needs to be taken by the professional as well as businesses. We'll look at what the outlook of the industry is to these provisions, and at the end we have also prepared a template for working on this MSME related interest calculation and all the whether it will be deductible in this year or the following year, and that template we will also share with all of you. So let's discuss first the applicability. It applies from 1st of April 2023, which means that it is applicable for financial year 23-24. And this is the first time, the first tax year in which this has an impact. So any outstanding which is before 31st March 2023, means that was already outstanding on 31st March 2023, would not be impacted by this provision. So again, when we look at the applicability, the first thing that we want to discuss is what is the applicability for assessees. The first, if you are following the cash basis of accounting, then this provision is not applicable to you. If you're not following cash basis of accounting but you're still covered under the presumptive taxation, still that is not applicable to you. And if you are not under presumptive taxation, and then this provision applies to you by default, as we are discussing, 43B is the part of PGBP, so you should naturally have income under the head business for applicability of this provision. Now let's look at the MSME law and how these enterprises are classified under the law. So there are two sections or two categories based bases for which entities can be classified. So enterprises under MSME law can be one classified on the basis of the thresholds. Now thresholds are micro, small and medium, where micro is investment in plant and machinery less than equal to 1 crore and turnover less than 5 crores. Similarly, small has a threshold, medium has a threshold, and then there are classification based on the activity of the enterprise. Now, largely under the MSMED Act, enterprise is defined to include only manufacturing and service entities. Whereas through an office memorandum dated the 2nd of July 21, trading entities were also allowed to be registered under the MSMED Act. Now, the limited purpose for which this registration was allowed was specifically mentioned for priority sector lending. And with that, this entire ambit of trading enterprises coming into the MSMED Act came into picture. However, there was also another office memorandum dated the 1st of September 21, wherein it was very categorically and specified clearly that the payment benefits under the MSMED Act do not apply to this trading entities which are registered under the MSMED Act. That brings us to the next section of our video, which is about the provision itself, section 43B clause H. And here we need to understand that first it applies only to micro or small enterprises and it does not apply to medium enterprises. So if when we look at the classification based on threshold, medium enterprises are out of the coverage of 43BH, which means that even a medium enterprise which is into business or profession by the other way of classification, it would not matter, and medium enterprises would be out of this provision. Then it only covers enterprise. As we discussed, enterprise only included service and industry, and then it was basically trading entities were covered under this. But would traders be covered? It's a burning question around it, and we'll have to just look at traders whether they are covered under the time limit specified in section 15. My view to it is that it would not be covered, and traders per se through that office memorandum do not have any payment protection under the MSMED Act. Basis that traders would not be covered in this, and hence traders, irrespective of they being micro or small, they would not be covered under this provision. Now, the specific exception to 43B items, as we know, is that if the payment is done before the due date of filing the income tax return, it still continues as a payment, and that is covered as an expenditure which is allowed as a deduction. However, for this specific clause H, there is an exception, and this exception says that this expenditure related to MSEs, micro and small enterprises, which is not paid within the time limit specified in section 15 of the MSMED Act, will be allowed only in the year of payment. So it doesn't make a difference if that outstanding is cleared before the filing of tax return, and hence there would be a natural deferment of claiming the deduction to the next year if they are not paid within the time limit. Other consequences obviously follow relating to interest and other things, but that's not the subject of this video. So that brings us to an interesting question as to whether unregistered parties are covered under this provision. To which our view is that unregistered parties do not have any payment protection under the MSME law, and that's where the time limit specified in section 15 does not apply, and that's the reason why they would also not be covered under the 43BH provision. Now, this is a simplified version of how the MSEs are protected under payment through the MSMED Act and its interplay with 43BH. So the flowchart that we have designed here is basically something that you would require, and this is all that you would require to completely understand this provision. So if we just pay attention to this particular slide, we'll be very clear on how this particular provision impacts you, how it impacts businesses in general, how it is protecting MSCs, and how does it, operate in its overall manner. So the first question you ask is whether the party is registered under the MSMED Act. Now, if the party is not registered under the MSMED Act, then the question of them getting any protection of payments or any other protection within the MSMED Act or 43BH applicability does not come. So they are completely excluded. If that party is registered under the Act, but it is registered as a trader, still that does not apply. Trader may be micro or small, but that does not have any coverage of interest payment protection, and same, it does not have any applicability of 43BH. The third is whether the party is micro or small. If the answer to this is no, which means that the party is registered, it's not a trader, but it's a medium enterprise, then also 43BH does not apply, and payment protection provisions of MSMED Act also do not apply. If the answers you reach to the flowchart where there is, the coverage is there, now applicability is determined, but here there is now the question of whether a credit period has been agreed between the parties. If the credit period has been agreed between the parties, the next question that you have to ask is whether it is less than 45 days. If there is no credit period, then Act has a provision that 15 days is what is the period within which the payment has to be made. If the payment is made within those 15 days, then that becomes an allowable expenditure. If it is not made within that 15 days, then the next question you need to ask is whether this is outstanding on the last day of the financial year. If it remains outstanding on the last day of the financial year, then you would reach a stage where it has to be disallowed. And similarly, the flowchart where you have a credit period agreed, and if that credit period is less than 45 days, then the payment has to be made within that credit period for the expenditure to be allowed. If it is not made within that time period, you have to go to the last question, which is whether it is outstanding on the last day of the financial year. If it is outstanding, then you have to disallow it. If it is not outstanding, then it has been paid lately, means in a late manner, but within the financial year. So again, 43B won't apply because the deduction would have to be claimed in the year in making the payment. And similarly, when there is no other applicability, this flowchart would guide you completely on how this 43BH would apply, as well as whether interest or other MSMED related questions have to be asked or answered. So, what is a brief summary of actionables out of this? We have tried to keep the video as short as possible and give you maximum content out of it. So, ultimately, the brief summary for the current year, which is 23-24, boils down to that there are no opening disallowances. When there are no opening disallowances, you cannot have a coverage for this year. However, the problem that occurs is that if you have an opening balance which is still unpaid at the year end for micro or small, then interest consequences are just too significant. And what happens for the next year? So now the second bullet covers the points for the coming financial years, where you'll have to maintain a tracker of opening disallowances and see if those opening disallowances are paid during the next year. So if they are paid off during the next year, you'll have to make a claim in the next year, and that's how the tracker would have to be maintained. And again, for every year, including this year and the next year, the outstandings outstanding balances on the last day is what needs to be analyzed, which means that they are not paid. If the expenditure has been paid, then naturally, unless they are relating to opening balances, they would naturally be claimed in the current year's tax computation. Now, we look at the case studies, and the case studies are typically where the thumb rule comes into picture. The micro or small enterprises that we are looking at. We are looking at first condition, it has to be outstanding on the last day of the financial year. So that is the first condition that it needs to fulfill. Plus, we need to look at whether the credit period, if it is not defined, whether it is paid within 15 days. If the credit period is defined and it's less than 45 days, it has to be paid within the credit period. And if it is agreed between the parties but it's more than 45 days, then the act comes into picture and 45 days is the cap. And if the payments are made within this date, then the deduction is allowed. If it is not done within this particular dual conditions, the expenditure that is claimed as a deduction would have to be disallowed. If we look at case studies, we are just looking at credit period. The first case where credit period is not defined, the date of supply is the 1st of March, the date of payment is 31st March. So even the payment is beyond the 15-day limit which is allowed, it will still be allowed as a deduction because it's paid in the same financial year. Similarly, if the credit period is 60 days agreed between the parties, the act comes up with a 45-day period only, which is not 14th of April. So if the payment is made within the agreed time period but it is beyond the statutory limit, it will be disallowed. Similarly, there are other case studies which you can understand based on our discussion, and you can pause the video and have a look. Now we shall discuss certain difficult situations, and they are largely those situations that have application of professional judgment, as well as they are difficult situations where you'll have complications arising out of the matter, and there would be more than one views. So the first is relating to the provision of expenses, and here typically the first thing that comes to my mind is the tax audit expense itself, because the tax auditor is required to certify the disallowances under 43BH. And let's assume a situation where the tax auditor itself is a enterprise as a micro enterprise under the MSMED Act. And in this situation, uh, there is a provision of expense for tax audit done in the financial statements for 31st March 24. And when the tax auditor would be certifying the tax audit, and it would be issuing the report, whether the tax auditor would consider this as an unpaid item, and would the tax auditor disallow it, or would the tax auditor see that this is a provision, it was not payable at the year end, and hence they would allow it on accrual basis. Our view here is that the tax audit or similar provisions should be allowed and should not be subject to 43B, because one, they do not become payable, plus two, you can track the you know compliance with the provisions of whether the payment is done or not only once the invoice is there or the services have been received. So ultimately, that's an impossibility of an event at the year end, and we would possibly go for the view that those provisions which are not paid in the time will make the disallowances when the invoices come and they're not paid in a timely manner. So I think that would just defer the disallowance by 1 year, but that would largely be uh, compliant with the provisions, because in principle they should be there. The second is retention money. To my mind, it's largely academic for 43BH, because that would possibly be more for capital goods and not for revenue expenditure. However, those who are into the business of manufacturing capital goods and they take inputs from suppliers which are MSEs and then they hold retention, that's a separate situation representing a small population. However, the larger idea is about the interest consequences, that even, it's not academic for interest, because if they have outstanding and it's not paid off, now it's an altogether different debate, conflicting judgments about retention money. But that's something that's a gray area where there would be a lot of you know conflicting views. Check whether, now there is a facility to check the udyam status, and you get all the details about whether the registration is this, or what is the category of registration, which is the based on the thresholds as well as based on the activity. So whether that needs to be checked individually or not, that's a big question that's coming up. And to my mind, the law, if you want to apply it in full spirit and the letter, then you would have to do an individual check. Now, what's the outlook of the industry? We discussed this important provision, and now we need to understand what the industry is looking at this provision as, and how difficult it is becoming for the industry to comply with this. So the first one is that there was a recent news article that highlighted what large companies are doing. The first thing that it highlighted was the large companies have taken a view to send registered letters to vendors seeking MSE classification, and the assumption is that if no reply comes back, the company or the entity is not registered under MSE. The second is about issuing checks to suppliers. That is one which is to be deposited on agreed date. So, for example, if two parties have agreed on a 60, 70, 80-day credit period, they would issue the check on the 45th day, and the agreement side letter with the vendor would be that they would deposit it later. However, this is completely, not appropriate for many reasons, but that's how the news article discussed about it. And the third was to ask vendors to surrender or modify their registrations under MSE. And so the sword that they would give is that if you want to continue doing business with us, then you have to actually let go of your MSE registration. And with that, we'll also give you some insights from our discussion with industry, our clients and other industry members. The first thing that comes to mind is that it's a very complex provision, and the impact is very far and wide reaching, and that's one pain point, that in the already increased complex regulatory and compliance environment, there's one more complication that businesses have to deal with. And this adds to the frustration of the compliance team, especially the accounts and finance team, that more than the functions that are necessary for the operation of the business, we are more focusing on what is relating to the compliance and aspects relating thereto. And to ensure 100% compliance is just a sea full of efforts that need to be done. And largely the overall, just like the news article is mentioned, overall industry is also mentioning that if there's so much of hassle of doing business with MSE, and largely the supplies are something that we take which are not material for those large enterprises, they are also in a way looking at discouraging MSEs if this remains the norm, because there's so much additional disclosures under the Companies Act, interest provisioning, interest disallowance, and now even payments under 43BH. So that's a broad idea of how we have been been asked about it. While the intent of the legislation is, there's no doubt about it, but the difficulties and challenges that are coming up on in implementing this provision is itself such a difficulty. Now today there's no bulk facility to verify Udyam registration. Without that, it would be very difficult for a business to actually comply with this provision, because a business would then have to go individually to put Udyam. Secondly, not all MSC registered vendors mention Udyam on the invoice. And then when the payment is delayed, or the agreed terms, they mention 90 days, but then they come forward with a demand of interest, and that's when they are blacklisted also because the at the first time they did not transparently disclose about their registration, etc. And many businesses have also taken up a additional process of having a MSC declaration as a vendor creation form. That those businesses who want to do business with us, they need to give us a vendor registration form, including their MSC registration declaration as to whether they are registered and if not. So that's something that sums up our understanding and discussion around this. Now we'll shift to our template for working, and we'll explain you how we have prepared a working paper that would capture the disallowance under 43BH and act also as a tracker for the next year. And we'll move into an Excel sheet for analyzing it. Yeah. So this is basically the Excel tool that we have prepared. It has various cases and it's all formula linked, where you have to input this from a drop down. This is also the classification based on thresholds, based on activity, the date of invoice, the date of supply, the amount, whether written agreement exists for credit. If no, then that has to be no. The credit days, which are then calculated automatically based on these inputs, the date of actual payment, which needs to be input manually, then the rest of the calculations happen, and whether this is a disallowance under the current year, or and what is the interest calculation based on these facts are mentioned here. And these are all formula driven, so essentially if you can populate this for your business, you would get an output which would give you the calculation of disallowance of principal under 43BH. And to get a copy of this working file, we'll have the link of the file in the description of this video, and you can input your data, and then the file would be received by you over email. And I think through this video, we would have given good clarity on this provision, and most of your questions would be answered. Still, if you have any other questions which remain unanswered, then we are happy to discuss them with you, and actually, learn in the process and help businesses be compliant with all the typical situations that this provision envisages. Once again, thank you for joining us, and I hope we have been able to clarify this specific provision with much detail, and this becomes the single source for you to understand this provision and apply for compliance in your business. Thank you.